Welcome all, this is Abhilash. This is the last session on the Unit 4 Dividend Policy. So, in this session, I'm going to talk on the dividend policy. So, we have three theories of the dividend: Walter model, Gordon's model, and the Modigliani and Miller's hypothesis. So, some of the major different theories of dividend in the financial management are as follows: Walter, Gordon, Modigliani, and Miller's hypothesis. So, on the relation between the dividend and the value of the firm, different theories have been advanced. So, they are as follows. So, first is the Walter model. So, before discussing the Walter model, let me tell you about the dividend. So, dividend subject we have discussed in the money and banking subject as well. Okay, so it's again let me repeat. A dividend means a part of a company's profit that is paid to the people who own share, or or a part of the company's profit that is paid to the people who owns who are the shareholders of the company. Okay. So the amount of division, the amount or number to be divided is called the dividend. Divided is the whole that is to be divided into parts. Okay. So first model of the dividend policy is the Walters model. Professor James C. Walter argues that the choice of dividend policy almost always affect the value of the enterprises. His model shows clearly the importance of the relationship between the firm's internal rate of return and its cost of capital (RNK) in determining the dividend policy that will maximize the wealth of the shareholders. The Walters model is based on the following assumption. First, the firm finances all the investment through the retained earnings, and second is that is a debt and equity is not used. The firm's internal rate of return R and its cost of capital K are constant. All earnings are either distributed as a dividend or reinvested internally immediately. Beginning earnings and dividends never change. The value of the earning per share and the divided per share may be changed in the model to determine results, but any given values of E and D are assumed to retain constant forever in determining a given value. The firm have a very long or infinite life. So Walter's formula to determine the market price per share P is as follows: P is equal to D divided by K plus R in bracket E minus D divided by K by K. The above equation clearly reveals that the market price per share is the sum of the present value of two sources of income. First is the present value of infinite of the constant dividend, that is D by K, and the present value of the infinite stream of the stream gains, that is K by K. Okay, so formula is the P is equal to D divided by K plus R in bracket E minus D divided by K and K. Criticism: the Walters model is quite useful to show the effects of dividend policy on all equity firm under different assumptions about the rate of return. However, the simplified nature of the model can lead to conclusions which are not true in general true of Walters model. The next is the Gordon model. On very popular model explicitly relating the market value of the firm to dividend policy is developed by Myron Gordon. So the writer name is the Myron Gordon. Myron Gordon's model is based on the following assumption. The first assumption was the firm is an all equity firm. Second, no external financing is available. Third, The internal rate of return of the firm is constant. 4. The appropriate discount rate of the firm remains constant. 5th, the firm and its stream of the earning are perpetual. 6. The corporate taxes do not exist. 7. The retention ratio, once decided upon, is constant, thus the growth rate G is equal to BR is constant forever. So K is greater than BR is equal to G. Is this condition is not fulfilled, we cannot get meaningful value for the shares. According to the Gardner's dividend capitalization model, the market value of share PQ is equal to the present value of an infinite stream of dividends to be received by the share. Thus, the formula for calculating the Gardner's model, as per the Gardner's model, is P is equal to in bracket 1 minus B divided by K minus BR. The above equation explicitly shows the relation between relations of current earning E, dividend policy B, internal probability R, and the all equity firm's cost of capital is equal to K. In the determination of the value of the share is easier. So this is how one can calculate the value of the share by using the above formula, that is current earning in bracket 1 minus dividend policy divided by the all equity firms cost of capital, that is K minus internal profitability. The third and the last dividend policies uh, third and the last theory of the dividend policy is Modigliani and Miller's hypothesis. According to the Modigliani and Miller dividend policy of a firm is irrelevant as it does not affect the wealth of the shareholders. They argue that the value of the firm depends the firm's earning which result from its investment policy. Thus, when investment decision of the firm is given, divided dividend decisions, the split of earnings between dividends and the retained earnings is of no significance in determining the value of the firm. So MM's hypothesis, Modigliani and Miller's hypothesis of irrelevance is based on the following assumptions. The firm operates in perfect capital market. Tax do not exist. The firm has a fixed investment policy. Risks of uncertainty does not exist. That is, investors are able to forecast future prices and the dividends with certainty, and the one discount rate is appropriate for all securities and all time period. Thus, the formula is R is equal to K is equal to KT for all T. Under remaining assumptions, R will be the equal to the discount rate and the identical of all shares. As a result, the price of the each shares must adjust so that the rate of return, which is composed of the rate of the dividends and the capital gains on every share, will be equal to the discount rate and be identical for all shares. Thus, the rate of the return for share held for 1 year may be calculated as follow: R is equal to dividends D plus capital gains P1 plus P2 no loss divided by the purchase price. PO is the purchase price, where P is the market or purchase price per share at the time O, B is the market per share at the time 1, and D is the dividend per share at time 1. As hypothesis by MM, R should be the equal of all shares If it is not so, the low return yielding shares will be the sold by investor who will purchase the higher return yielding shares. So we have learned the three theories of the dividend policies. Thank you. Best wishes.